Hey guys, I'm Big Mike, and like always, I'd like to thank you for being here today. Today we have another Ask Me Anything session with FuturesTrader71. The AMA sessions are designed to be quick and casual. There's no prepared presentation, and they are limited to 30 minutes. Go ahead, guys, and start typing your questions right now. I'll be turning things over to FT71 in just a second, and we'll try to get everyone's questions answered. The recording for the AMA session will be uploaded to the AMA thread on BMT later this afternoon. If you're not sure how to find it, you can go to BMT on the top right of the page next to the search option, type in AMA space FT71, and that'll take you to it. All right, guys, here's FT71.
Good morning, everyone. Can you hear me? Test? Can you guys hear me? Okay, thanks. Real quick, I have to start with a risk disclosure. It's required by the NFA. Zone futures and retail off-exchange foreign currency transactions involve substantial risk of loss and is not suitable for all investors. Not sure why my slide is that way, but past performance is not indicative of future results. So let's look at our questions.
Hey, FT. All right, first question comes from Mr. E. He says, FT, what is the most valuable piece of information or lesson learned that made it click for you?
Wow, really good question. You can almost talk about that for a long time, but the key element, which I think escapes pretty much anyone that I've come across in the last 3 years being out in the public, is just non-respect for risk. The idea that hey, I can get in here at $500 a contract and make myself, a few $100s a day by just guessing where I should get in and out of trades. To me, that idea has probably cost more people than we can count their accounts. So I think the short answer is, the thing that made it click is, to be blunt, is stop being stupid. I used to come in. I used to have a small limit, like $500 or $300, I think, when I first started in futures. And I used to come in and I used to hit it within 25 minutes of the open. Wow, you're really climbing here. 25 minutes within the open, and that was it. I hit my limit for the day. Platform shut off, and I have to sit there all day long and watch the market and do homework and listen to other people trade and make money. So to me, until I got to the point where I just said, just cut the emotional stuff out and really develop, a way of managing risk, cutting my risk down, and really trade probabilities. I think that's the hard thing, is like getting people to understand that as a trader, you cannot know what the future holds on this particular trade, whatever trade you're taking next. And so you really need to live by the probabilities. In order to live by probabilities, you have to do homework. You have to see, and I just answered a question this morning for someone in the AMA thread on Big Mike. With regards to that, the person was asking, hey, how do you, fine, I get the theory, but how do you enter? How do you know where to enter and exit? And the answer, quite simply, is you test it and test it and test it until you become really, really familiar with how this beast moves. And then based on that, you start to formulate a plan. And you get more and more comfortable with that plan as long as you maintain your discipline. That's what made it click. And I actually ran my account way down and actually was running out of money when this happened for me. It went from something I did as a kind of a hobby, not a hobby because I was part of a professional trading group, a prop shop, to something where it was a survival thing, where I was down to a few $1,000s and a new baby daughter and so on, and it's just like, okay, enough's enough. And that's what it is. I think most of the time it's people's attitude and commitment to this that really gets them. You know, and it's something I struggle with all the time on days like yesterday, where I watch people just chew through 20-30% of their account when it's just not necessary to do that. Hope that answers your question.
Okay. Chuck has the question, do you trade breakouts of the open swing high or low, or do you trade off those levels if price hits them later in the session?
I do under certain circumstances. If there's, and I might lose some of you here, if it's an open auction out of range type opening, and I suggest you just look at some of the videos on my website. If there's an open auction out of range, in other words, the market opened way outside of the prior day's range, and instead of blasting towards the prior day's range or blasting away from it, it trades both ways, which means that the bigger traders, the larger participants, are waiting on the sidelines to see, is it okay to step in now and execute a 50,000 contract trade or whatever size they're trading. So what it does is it opens, and then it goes up, then it crosses the open and goes down, then it crosses the open and goes up. And today is that kind of an open where it's an open auction. If you look at today's chart, this is a 2500 volume chart. This is an open auction right here where it's just trading both sides. This is what's called an open auction. I do not trade breakouts on a day like today because we opened in the prior day's range, in the prior day's value, although there is no value in a trend day. But had this open occurred way down here, actually there's a huge gap below us here, painted green, but had it open out here and it started to break higher under that circumstance, I do not chase, but I would take a breakout if the opening swing is tight. In other words, it's less than 2.5 points, and it starts to break out. Then I may take a breakout. But generally, I don't trade breakouts because by the time the breakout happens, it's already moved so far.
Frank asks, on the image you posted on Twitter this morning on the volume breakdown pain indicator, what are your preferences?
I don't remember what image I posted, but it's probably what you see here, right? If you're here, just say yes or no. What are the preferences?
He says yes.
Okay, yeah. The preferences for the volume breakdown is right here. These are called delta bars, and all they're doing is these are bars that are created. Let me zoom in a bit. See, all these are it's a measure of the number of contracts that have been traded at the offer, in other words, at the asking price or the next higher price. It measures that minus the number of contracts traded at the bid, in other words, aggressive sellers. So this is just measuring people who decided to cross the market and actually reach higher to buy or reach lower to sell, and it subtracts the two from each other and tells you the exact contract count of that per bar. This is a 2500 volume bar, but if I switch to like a 3-minute, the bars get bigger. So what this is saying is when this particular bar, this green bar up to 61.25 happened, about 8,000 to 9,000 contracts lifted the offer than hit the bid. That's an aggressive buy. So those are the parameters. The lines behind it, the gray bars behind it, is what's called delta momentum. All this is it measures consecutively when the delta is negative, it keeps adding them together so I can see what the momentum is in that move.
Okay. So that's just that's cumulative delta, right? That's what it's known as, at least on BMT.
Yes, cumulative delta.
Okay,
Yeah.
Jeff asked the question, FT, I know that you use larger rotations to get into a trade. What do you do upon, say, a high, tight bull flag setup where you don't get the rotation? You just above a key level, like an IB or a composite low volume node, is that a trade you would not take?
Okay, so is this such a situation right now? Just so I understand the context of the question, are you speaking of something like this, where it's just reached a high and it's flagging and there's nothing for you to trade against, Jeff? Okay.
He says yes.
So we've made, let's go back to the 2500 volume chart, which is what I trigger off of. We've made an 11-point rotation. The probability of an 11-point rotation in ES historically in a one-year data set going back from March this year to March prior year, the probability of an 11-point rotation is less than 2%. It's actually less than 1% of the time. So this is an extreme, and that's 11 points without a 6-tick pullback. So basically it went up, it had these pullbacks, but none of them were 6 ticks or better. That's what this is saying. So for that to this tells me that the third force, or the bigger force, now is in the market. So I don't want to fade these kinds of moves unless I have something dramatic to trade against, something like a CLVN, like this point right here on this profile that shows that there is no interest in this price. Otherwise, I need to wait for the IB to come back, or something else to set up, a midpoint, something. What I won't do is get emotional and say, oh my God, I'm going to miss this. Yeah, the zigzag seems wrong here, I agree. What I don't want to do is basically get emotional about missing the trade, which is one of the psychological triggers for traders. There's a fear of missing out on a trade, and there's a fear of losing, and those are equally powerful. So what I do is just trade the plan. In other words, I need for this to come back to a reasonable area. I need for it to come back to a reasonable price for me to buy. Okay?
Okay.
So no matter what, I'm not going to trigger a trade without something to lean against.
Trade Dog is asking, how do you take your homework levels into executable trades? Is there anything that you look for taking theory into practice?
So, yeah, I just answered this in the forum. Really, it stems from understanding what an auction is and what an auction does. So for me to take what my homework is and turn that into an actual trade, I already know, and if you follow me on Twitter, you'll see it, or you can just go look at it now. You'll see what I'm outlining for the day. So what I'm outlining are my expectations for the day. My expectations are based on my understanding of what the market's trying to do. And I do that by looking at bigger time frames. What is this market trying to do? It's balance, breaks out, balance, breaks out, then it falls back into balance. So I'm expecting this market to struggle with this volume down here that we put in from March 5th till April 9th. I expect it to struggle, so I'm not looking for any breakout trades here. That sets the tone for the day for me. You know, both trading plans at the highest level need to start with what kind of a day am I expecting, or am I in? Am I in a trending day, or am I in a balanced day? Those, if your trading plan does not break those two apart and come up with some sort of a plan, a different plan for each, then I would suspect that your trading plan will experience hardship when the market changes modes, and the market changes modes all the time. So the idea for me is to recognize early on what kind of a day am I going into here, and having opened in yesterday's range, in balance basically of yesterday's range, I know that I need to just back off. It's local to local trading, it's trader to trader. I need to back off. So having that context tells me, okay, I'm going to be trading from extremes back in wherever I can find those areas. And the key area for me today, again, if you look at my Twitter feed from before the open, key area for me today was 65 a test of 65. I expected this to break higher on the open. I expected the overnight high of 59.75 to be taken out early, which it did. However, it fell all the way back down to 54.50, which is the high before the close yesterday, before this move up. I expected this move up. So I'm looking, so the theory is it's balanced, the market's going to struggle, it's a two-way thing, we had a trend day, so I expect it to go back and forth. So that's the big idea. The actual trade triggers against some homework level that I have, and I've done enough homework and I've studied it enough that there is no question what I'm going to do once we get to that area. And I think that's the biggest difference. I think a lot of times when I receive this question and I start to dig into the reason behind the question, I find that folks want to simplify it to the point where it's like almost like a systematic mechanical answer. Oh, if then else, if it does this, then I do this, else I do that. And I don't trade that way, and I know there are a lot of people who are systematic and trade that way, but I don't trade that way. I trade an auction just like a local in the pit who sees an excess in prices or an excess in volume going one way or another, and then tie that in with a predetermined homework level. And then the third key part is risk control. If I get those three pieces together, then that's a trade, and it happens almost unwillingly or thoughtlessly, because I have no thinking to do at that point. I know that if I get a good enough rotation in an area I'm interested in, if I can get a counter rotation of 1.5 points, 2 points, so I can take risk off and hold on to something, then that's what I will do. Okay, and so I can't give you an answer that says I wait for the 8 bar moving average to cross price and then I trigger it. I don't trade that way.
Okay, Chris is asking. He says, and after the last webinar that you did, he went to your site and he created an account. I'm assuming he's talking about the FuturesTrader71.com site, and he says he's confused to what services you offer. Will you please go over the different options that he has in order to learn from you?
Well, the website, not to get it too much into history, but the website was created as a result of coming online in 2010 or 9 or something, where I just started to talk about, just in generality, about trading, just trying to create a community, I guess. And I kept answering the same questions over and over and explaining the same things over and over. I would do these impromptu chats after the market closes, and somebody decided, somebody came forward and said, look, I can create a website for you so you don't have to keep talking about the same thing over and over and over. And then the website, a blog was born. Then eventually it got to be so difficult to keep up with the questions and folks sending me their stories and trying to help people that I actually was going to just stop doing it because it was just becoming too much and was interfering with my trading. And so eventually what was decided was let's create a webinar series, and people would pay for that webinar series, and then the money for that would go to a charity that I started in 2008 because the charity had lost its grants when the market, when the economy crashed or corrected in 2009, 2008. And that's how it started, and that's all it is. The website is just a depository of information based on what I research, my experience, questions that I get asked a lot, and so I make a video and I post it on there. However, under the brokerage that I'm a part of now, there is a process by which we are rebuilding the website to become much more comprehensive in its handling of traders and what they need. In other words, we want to create almost like an online university type of environment, and that's a thing in the works, including the potential for mentoring and things like that. But my time is limited, and this, trying to keep up with everybody is really, really demanding as I'm sure it is for Mike with the forum, for example. So it's my priority is really taking care of the traders that are part of the brokerage right now, handling their issues, and then but eventually it's going to go public, and hopefully I can provide something more comprehensive. But for now, it's just a depository of information.
Okay. Naguib is asking, for someone who is trading on sim, trying to prove their trading plan, what kind of expectancy would you say that they should achieve before they start trading live? And would you say that a good expectancy for a trader is his first year of consistency?
Excellent question. Excellent question. First of all, expectancy is simply your win percent times your average winner minus your loss percent times your average loser. It gives you a number, and it's either dollars, points, or ticks. Depends on what you use for your average win and average loss, okay? I prefer to use ticks. Forget dollars. Don't use dollars in anything that you do when you're trying to learn this, because dollars create emotion. They create a tangible thing that we hold on to. So I'm going to talk about it in terms of ticks. So with, for example, the trade analyzer that we have, the ultimate goal here is to figure out what is your expectancy for the very next trade based on the 200 or so trades that you've taken already, or how many ever there are. Your expectancy tells me what is the likely outcome of the very next trade. And so a few things you have to pay attention to when you're in sim. One, you should always penalize your exits by a tick if your exit's a limit. You should not do so for a stop. A stop is a stop, and assuming the product is liquid enough, the stop's going to get triggered at market. However, most simulators don't cue you the same way the market does. Our trading platform tries to, but it's not always able to. But when you put out a limit, like let's say you bought 61 1/4 and you have an exit at 64, and the market comes up and fills you on sim, chances are it'll fill you as soon as 64 is touched. Assume that you didn't get filled until it touches 64 1/4. You want it to trade through 64. So that's one thing, and that's going to reduce your expectancy quite a bit. Okay, but you have to do that to represent what reality is going to look like. So don't take your sim results as they are. Your stops are fine, but your exits, your limit orders when you exit trades, really needs to be penalized by a tick. So once you do that, do the computation, make sure you do that. Second, the expectancy for you to be flat after paying exchange fees and commissions and all the costs that associate with trading will be approximately 1 tick per trade. Okay, so that's about the expectancy that you would need. That's $12.50 in the ES. Are your costs $12.50 per trade? No, but throw in your charting package and all your other expenses, and it goes up to $20 sometimes or whatever. But expectancy for you to be flat is probably a tick or two. I would not go live with anything that's less than 4 ticks or better. You need 4 ticks or better. That's $50 per trade in order for you to go out live and start testing your system live. And that's the reason why I've been pushing our trading clients towards trading something like the micro euro, the M6E contract. So we've made a push to reduce the cost of the M6E and then have people trade that product live at $1.25 a tick. It's a very, very small tick, so that they can experience the emotions involved with trading, learn how to monitor and journal their progress live rather than doing it through a simulator. But essentially what you need is probably a 4-tick expectancy would be ideal. It's very, very hard to get 4 ticks per contract, trust me, as an expectancy, because when you factor in your losses and your wins, that number falls fairly quickly. But if you can get to 4, that's an excellent starting point in my opinion.
Okay. Michael is asking, what are the two most important things to know in using market profile? And I think that it's fair to expand that question to volume profile like you use.
The two most important things to know market or volume profile. Um, it's hard to answer that. I mean, essentially what you're looking for when you're studying volume or market profile, and market profile is basically the original product that took 30-minute time slots and made a histogram like this, but using 30-minute time slots. Volume profiling takes actual volume and charts that. This is a market profile chart right here. Okay, so that's market profiling. The two most important things to know is the key thing you're trying to find out is where is balance? Where is balance? Balance occurs wherever the profile is fat. That's when sellers and buyers came together and agreed on price within a range. This range right now is 56.5 to about 62. Where's balance? That's what market profile charts that other products or other indicators do not show you. The other one is, okay, if I know where balance is, how much of it is there? In other words, as this gets fatter, let me try to use a pen tool here. As the profile gets fatter, as this profile gets fatter, there's a lot of energy because for every buyer there's a seller. There's never more buyers. There are never more buyers than sellers in futures. For every buyer there's a seller, and the fatter that is, the more likely that the move, when it goes into imbalance, is going to be stronger because the market goes from, hey, you guys, we agree on price, let's trade back and forth, right, to, hey, we got to reprice this thing, let's move to another area. So the market goes from balance to imbalance to balance to imbalance, and that's what it does historically. And so I want to see how much balance there is. If balance comes in and it looks really sharp like this, then I expect this move to be a lot stronger. There's a lot of energy. There are many people who sold when it breaks higher that are going to have to, that are likely going to be pushed out, and so my targets become bigger for my runners. But market profile, volume profile, the key is where's balance, and what is the market doing against or relative to that balance right now.
Okay, Ben is asking, FT, I'm sure that you still have slumps in your results, but at this stage in your development, do you have any slumps in your execution and where you find yourself repeatedly deviating from your plan and trading impulsively?
Absolutely. Everybody has rough patches. If you run into somebody that says I never do, I would look at their statements. But I absolutely have slumps and rough patches, and it comes with life. Like just issues outside of your control can affect you psychologically when you come into work. You didn't sleep well. You got into an argument with your spouse. Whatever. So it happens, and also sometimes my read on the market just isn't there. Like I'm out of sync. It's time for me to take a vacation or take a break away from trading. So slumps do happen. Slumps happen generally when I'm deviating from my plan. So it's a great question. It's a two-part question, but both parts are connected. I do deviate from my plan. I'm generally sorry for it. The market makes me pay. I might get away with it 6, 7, 8 times. And then whack, I have to be reminded that I violated my own rules. And so it's not smart, but there's always that impulse. I'm aggressive, I'm competitive, and I want to push when I can push, and it doesn't often work. And generally, it forces me to go back to the drawing board or to go back to what I'm supposed to do and to just sit on my hands when I'm supposed to sit on my hands. And that's something that everybody I would guess that everybody would struggle with throughout their career, that they got into a trade impulsively and they shouldn't have. Hope
Okay.
that answers it.
Sure. Elena is asking, FT, what market breadth indicators do you pay most attention to? For example, ticks or VIX or something else. Do you use them for initiating trades or as a filter only? And I want to add to that a later question that came in from Bob on a similar topic. He says, can you explain the S&P issues tick? Is it similar to the NYSE tick? And we'll make this the last question since we're at 30 minutes.
Okay, so let me take Bob's question first. The S&P tick issues are the same as the New York Stock Exchange tick issues, but the S&P tick issues, and I have it on a 15-second chart here, is only looking at the S&P 500 stocks, the underlying stocks in the S&P 500, upticking and downticking. So the tick is basically measuring right at this moment how many stocks uptick minus how many stocks downtick at this very moment, and it comes up with a number. Right now it's between 6, 22, -4, and so forth. The difference between the New York Stock Exchange tick and the S&P 500 tick is the New York Stock Exchange is looking at a universe of 8,700 or 8,900 or some large number of stocks and is giving you that number in the form of an index. I'm not really interested in the New York Stock Exchange, and I'm not interested in almost all of those stocks. I'm interested, because I'm looking at the S&P 500, I'm interested in what the S&P 500 underlying stocks are doing. And so I look at the S&P tick instead of the New York Stock Exchange tick. Does it make a huge difference? Probably not. But I prefer to go with something I understand rather than something that's just out there and others are using. As far as breadth indicators, I don't initiate off of any breadth indicators like the I use the S&P breadth. This is the advancers versus decliners net on the S&P. I watch these just to give me context. I also use a cash index chart. This is a chart that is a percent chart, and I know the colors. It shows me the relative strength or weakness from the open of today of various things. The transports are leading the charge here. Transports, Qs are pink, so forth, and then you look down here, and it's the DAX is dragging since the U.S. Open, and of course now it's closed, but it's keeping things down. And this gray line here is the VIX. It kind of gives me a snapshot of what is going on in a contextual way. And then I look at financials and things, but I don't initiate off of those. I strongly recommend that folks do not initiate on the S&P using some other product. You need to initiate on the S&P using information that the S&P is generating for you. However, these other breadth indicators and looking at underlying stocks and things like that help you gain context, and that is the hardest part of trading, is gaining context and keeping context in mind, because if you have context and you're reading it properly, that's what we call being in the zone. You can put on trades almost randomly and be able to manage them as long as those trades are taken in the direction of the context of the market, you know. So that's really what I keep trying to stay on top of all day long, and I tweet about, is trying to always paint a picture for context. Hope that answers your question.
Okay, and with that, since we're at 30 minutes, we're going to make that the last question. I'll be posting the recording for this session in the AMA thread on BMT as always. If you don't know how to find it, you can go to bigmiketrading.com. On the top right next to search, type in AMA space FT71, and that'll get you to the thread where FT has been answering questions and where we've been recording these sessions. Okay, guys, thanks, FT. I'll see you in a couple weeks.
Thank you. Take care.
Thanks. Bye.